Your money is about to be worthless. I know that sounds dramatic, but stay with me because what I'm about to walk through is not some abstract financial theory. It's the actual mechanism that's playing out right now in real time. And the people who understand it are quietly moving their money into places that most retail investors would never even think to look. This isn't about doom. It isn't about buying freeze-dried food or moving into a cabin. It's about understanding how capital actually moves when the rules of the monetary system start to shift, and then positioning yourself on the right side of that shift instead of the wrong side. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily live streams on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link is in the description below. As always, this is not financial advice. Do your own research. Because here's the thing, dollar debasement is real, and I want to be really precise about this term because people throw it around loosely and it loses its meaning. Dollar debasement does not mean the dollar collapses overnight. It does not mean hyperinflation like Zimbabwe or Weimar Germany. What it means in practice, in the world we're actually living in right now, is that the purchasing power of your cash savings declines over time faster than any interest rate you're earning can compensate for. It means that the real value of your paycheck, your savings account, the money sitting in your brokerage account as cash, is being quietly, steadily, and deliberately eroded. And I say deliberately because once you understand the policy framework that's being built right now, it's really hard to argue that this is accidental. Let me explain what I mean, and then we're going to connect it directly to where money is rotating right now and why, because the macro setup here is not just intellectually interesting, it has real implications for how you should be thinking about your portfolio today. So let us start with the economy as it actually exists versus the economy as it's being reported to us, because there is a significant gap between those two things, and that gap's important context for everyone that follows. The stock market is at an all-time high. The Dow crossed 50,000. You got the President of the United States going on record saying he thinks the Dow will double to 100,000 before his term ends, which is a remarkable statement from a sitting president, and one that got a lot of people excited. And everyone who follows the economy knows on paper GDP is growing, unemployment's not catastrophically high, and the official inflation number has come down significantly from its peak back in 2022. So the story being told is that we engineered a soft landing, we got inflation under control, and now we're in a period of healthy growth. Except that basically nobody feels that way. In a YouGov poll from November, a full 53% of Americans said their household income is just barely keeping up with expenses. And another 32% said they're falling behind. So you got 85% of Americans either treading water or sinking, and we're being told the economy is booming. The reason for that disconnect is actually pretty straightforward once you understand it. Slower inflation does not mean prices fell. It means prices rose more slowly. Everything that happened to prices from 2020 through 2023 did not get reversed. Those price increases are permanently baked in. The egg you used to buy for $3 now costs $6, and it's not coming back down to $3. The rent increase you absorbed, the car payment you refinanced at a higher rate, the grocery bill that quietly crept up 40%. None of that went away just because the CPI moderated, and inflation-adjusted wages have been essentially flat since 2020. The Federal Reserve Bank of Atlanta has wage growth data that shows lower income workers have seen their real wage gains slow much more sharply than higher earners. So you have a situation where asset prices are at all-time highs. Wealthy people are doing better than ever and actually spending more, while lower income consumers are pulling back on expenses. That wealth divide is not a side effect of the current system. It is, in many ways, a feature of it. And here's where things get genuinely important, because that divide is potentially about to get significantly wider. And understanding why is the key to understanding the rotation we're going to talk about. The administration has nominated Kevin Warsh to be the next chair of the Federal Reserve. He's not been confirmed yet, but if he is, the implications for monetary policy are significant. Warsh has been pretty clear that he believes technology and AI are going to drive a major productivity boom. And his view is essentially that productivity growth is deflationary, meaning you can get strong economic output without necessarily generating consumer price inflation. That might sound reasonable on the surface, but follow a logic to its conclusion, because it gets uncomfortable pretty fast. If the new Fed chair believes that AI-driven productivity means we can have growth without inflation, that becomes the intellectual justification for lowering interest rates aggressively and running the economy very hot. Lower rates encourage investment. That's straightforward. But the critical question here is where that investment goes. If it goes disproportionately into technology, into AI infrastructure, into hyper-specialized capital-intensive projects that create relatively few broadly accessible jobs, then you can have strong GDP numbers without that growth translating into wage increases for regular people. The productivity gains flow to the owners of capital, not to the workers. That's not a new dynamic. That's literally just how productivity cycles have worked throughout modern economic history. The benefits of the loom went to the factory owners, not the weavers. Now, there is a counter argument here, and it is a real one. The AI build-out is also creating demand for physical things. You need people to build data centers. You need people mining the materials that go into chips. You need construction workers, logistic workers, facility managers. The capital spending on AI infrastructure is not purely weightless. There are physical supply chains attached to it that do generate broader employment. So it's not a pure doom scenario for workers. But even in the most optimistic version of the story, the benefits are concentrated. They're not broad-based, and the timeline for those benefits to trickle down to everyday wages is long and uncertain. Meanwhile, the math of what is happening on the debt side of the equation is happening right now. It's not uncertain at all. The U.S. Treasury has to roll over something in the range of $8 to $9 trillion worth of debt in 2026 alone. It's roughly a quarter of U.S. GDP that needs to be refinanced. The government needs to borrow at massive scale in an environment where the pool of willing buyers for U.S. treasuries is shrinking. China has been reducing its treasury holdings since 2012. Saudi Arabia and Russia have been doing the same. Japan has recently begun to pull back. The only major economy that's been consistently buying treasuries in large quantities is the EU, which holds about $2 trillion worth of U.S. government debt, and in 2025 accounted for roughly 80% of all foreign buying of treasuries. Now, here's the geopolitical wrinkle that's making institutional investors genuinely nervous. Europe held an emergency meeting recently where they explicitly discussed using their U.S. asset holdings as a bargaining chip in trade disputes. When the EU talks about leverage over the United States, they're talking about that $2 trillion treasury position. A study from the National Bureau of Economic Research estimated that selling just $100 billion worth of treasuries leads to a 19 basis point increase in long-term U.S. yields. If the EU were to sell 20% of its holdings, you're looking at close to a 1% increase in long-term yields, which would push mortgage rates, business borrowing costs, and consumer credit costs up meaningfully. Now, the EU probably does not actually sell in any dramatic way because that would hurt them too. It is a mutually assured financial destruction kind of situation, but the mere fact that it's being discussed, the mere fact that private investors can no longer treat EU demand for treasuries as a stable long-term assumption, that's already affecting how the bond market is pricing long-duration risk. You can see it in the widening spread between 30-year and 5-year treasury yields. The market is demanding more compensation to hold long-term U.S. debt because the buyer base for that debt is becoming less certain. So what does the U.S. government do when it faces this kind of supply-demand imbalance in the treasury market? when it needs to issue enormous quantities of debt, but the pool of willing buyers at current yields is shrinking? Well, one option is that yields just go up, which makes the debt more expensive, which makes the deficit worse, which is a brutal feedback loop. Another option, and this is the one that people who follow monetary policy closely are now openly discussing, is that the Federal Reserve buys the treasuries itself. You probably know this as quantitative easing or money printing, but there is a more formal version of this that some are now speculating Warsh might be pointing towards when he talks about creating a new accord between the Fed and the Treasury. Yield curve control is when the central bank explicitly commits to buying whatever amount of government debt is necessary to keep yields below a certain target level. Japan's been doing this for years. It's not some theoretical concept. The mechanism is simple. The Fed prints money to buy bonds. The Treasury gets to issue all the debt it needs. Interest rates stay low, or at least controlled. GDP gets a sugar rush from cheap money, and the dollar loses value because you have increased the money supply without a corresponding increase in real productive output. That is what dollar debasement looks like in practice. It's not a collapse, it is a slow erosion. Your dollars buy less over time, not because of normal inflation, but because the supply of dollars is being expanded to serve the fiscal needs of a government that's spending more than it takes in and cannot afford for rates to go up. And here's the thing about that environment that matters for investors. In a world where the purchasing power of cash is being actively eroded by design, the way you protect yourself is by owning assets that generate real income that grows over time. Not crypto, which is essentially a liquidity proxy and goes up when the Fed prints and down when it tightens. Not long duration bonds, which are directly in the crosshairs of everything we just described. Not cash, which is the asset being debased. You want assets with pricing power. You want assets with revenue streams that are tied to the real economy in a way that cannot be easily disrupted by software, by AI, by trade policy, by geopolitical drama. You want assets that people literally cannot live without paying for. And that brings us to utilities. I know how that sounds. The word utilities genuinely makes people's eyes glaze over, and I understand why. These are not exciting businesses. They do not have flashy earnings calls where the CEO talks about disrupting the industry. They do not generate viral news cycles. Nobody at a dinner party is talking about their electric utility stock. But that boredom, that complete absence of narrative excitement, is actually one of the things that makes them interesting right now. Because while everyone's watching NVIDIA and arguing about whether the AI bubble is going to pop and trying to figure out if Bitcoin is going to make a new all-time high, there is a quiet and very deliberate rotation happening among institutional investors, pension funds, and large allocators into regulated utility companies. And it's not random. There's a very clear and logical reason for it that connects directly to everything we just talked about. Let me walk through the mechanics. Utilities are regulated monopolies. They serve a geographic territory. They have a captive customer base that has essentially zero price elasticity, meaning people do not stop using electricity when the price goes up. And their revenue is set through a regulatory process that typically allows them to earn a predictable return on their asset base. That predictability is the whole game. In an environment where you're worried about dollar debasement, where you do not trust that cash will hold its value, where you are skeptical of long duration bonds because you're worried about the Treasury supply problem we just discussed. What you want is an income stream that's stable, that grows at a rate that at minimum keeps pace with inflation, and that is attached to a real physical asset that cannot be disrupted or replaced by software. Utilities check all these boxes. The infrastructure they own, the wires, the transformers, the substations, the pipelines, the generation assets, that stuff is worth more in nominal dollars as the dollar weakens because it is real physical capital. The replacement cost goes up, and the revenue is tied to rates that regulators typically allow to increase over time to reflect cost increases, including inflation. So utilities are, in a sense, a quiet inflation hedge wrapped in a steady dividend check. And that combination, the inflation protection plus the predictable income plus the real asset backing, is exactly what large allocators are looking for right now when they run through the logic of the macro environment we just described. Now, there is a second catalyst for utilities that is even more specific to the current moment, and that is AI. We spent a lot of time talking about the AI build-out and the CapEx cycle and the hundreds of billions of dollars that are going into data center infrastructure. Jensen Huang at NVIDIA was just out saying demand's through the roof and the $660 billion CapEx build-out is sustainable. Alphabet just announced it's raising $32 billion for AI infrastructure. Microsoft, Amazon, Google, Meta, they're all spending at unprecedented levels on compute. And all that compute requires power, an enormous, historically unprecedented amount of power. Data centers are extraordinarily energy intensive. A single large hyperscale data center can consume hundreds of megawatts of electricity. The aggregate power demand from the AI build-out that's happening over the next 5 to 10 years is going to be one of the most significant demand shocks to the US electric grid in its history. And who provides that power? Electric utilities, the companies that own the wires and the generation assets and the grid infrastructure that this entire AI revolution depends on. This is a part that I think most retail investors are completely missing when they think about the AI trade. Everyone's buying the chips, they're buying the software companies, they're buying the data center REITs. Very few people are looking at the companies that are going to sell the fuel that powers all of it. And the electric utilities that are positioned in the right geographies, that have the regulatory relationships, that have the balance sheet capacity to finance the infrastructure build-outs that the hyperscalers are going to need, those companies are looking at a demand growth profile that is unlike anything they've seen in decades. For most of the last 15 years, utilities were in slow decline as demand growth was essentially flat. Energy efficiency improvements were offsetting whatever population growth and economic activity would have otherwise driven electricity demand higher. The industry was essentially a melting ice cube, good for income, poor for growth. That story is now changing in a pretty dramatic way, and when a sector that had a flat growth story suddenly gets a legitimate growth story on top of its income characteristics, institutional money tends to show up. Now, I want to get specific here because I think there is one name that deserves particular attention in this context, and the reason I want to talk about it is not to tell you to buy it or not buy it. None of this is financial advice, and you should do your own homework, but because this company illustrates the thesis more completely than almost any other in the sector. That company is NextEra Energy. NextEra is the largest electric utility in the US by market capitalization and the parent of Florida Power and Light, which serves Florida, one of the fastest growing states in the country by population. But what makes NextEra genuinely different from a traditional regulated utility is that it is also, through its subsidiary, NextEra Energy Resources, the largest generator of wind and solar power in the world. It's not a pure regulated utility. It has a meaningful growth engine attached to it in the form of renewable energy development, and that growth engine is getting a significant tailwind from AI power demand. The reason this matters is that hyperscalers, the Googles, the Microsofts, Amazons of the world, have made very public commitments to running their data centers on renewable energy. They've signed massive power purchase agreements for wind and solar. And those agreements tend to go to the companies with the scale, the balance sheet, the project development expertise, and the regulatory track record to actually deliver. NextEra has all those things. They've been building large-scale renewable projects for decades. They have a relationship with state regulators across the country. They have the financing capacity to take on the enormous capital requirements of utility-scale generation. And they're sitting in Florida, which is one of the most active markets for data center development in the country, in part because of the power availability, the tax environment, and the lower cost of living that makes it attractive to the tech talent that needs to be near these facilities. The stock went through a difficult period after the rate hiking cycle began, because utilities are generally rate-sensitive assets. Higher interest rates makes their dividends less competitive relative to bonds, and they use a lot of debt to finance their capital-intensive infrastructure, so higher rates increase their borrowing costs. There was a period where NextEra was getting absolutely hammered along with the rest of the sector because the market was pricing in the idea that rates would stay high forever. But the macro thesis we've been building through this entire conversation points in the other direction. If the worst Fed is going to be oriented toward keeping rates low, towards running the economy hot, towards using the tools of monetary policy to ease the government's debt burden, then the headwind that has been weighing on utilities for the past 2 years becomes a potential tailwind. Lower rates means lower borrowing costs, which improves the economics of the massive capital programs these companies are executing. Lower rates means the dividend yield these companies offer becomes more attractive relative to bonds. And if you layer on top of that the AI power demand story, the real asset inflation hedge story, the stable regulated income story, you start to see why institutional capital is paying attention. I want to be clear that I'm not saying this is going to work perfectly in a straight line. There are risks. Regulatory risk is real in utilities. If a state commission decides it does not want to approve certain rate increases to certain capital programs, that can materially affect the economics. Interest rates did not fully cooperate with the thesis when the Warsh nomination was first announced. Gold and hard assets actually peaked around that announcement and have pulled back, which suggests the market is still digesting exactly what the new Fed policy direction is going to look like. There's also genuine execution risk in the renewable build-out. These are massive infrastructure projects with supply chain complexity, permitting challenges, and interconnection queues at utilities that can slow down the timeline between when a project is announced and when it actually starts generating revenue. And the valuation picture for some of these names is not cheap. When a sector gets a narrative tailwind, multiples can expand ahead of the fundamentals, and then you can have periods of consolidation or correction even when the long-term thesis is intact. We've seen that exact dynamic play out with basically every sector that's had a strong narrative over the past few years. So you want to be thoughtful about entry points and position sizing rather than just chasing performance, but zoom out from the near-term noise and the picture is actually pretty clear. You have a macro environment where cash is being debased, where the government's fiscal position creates structural pressure for the Fed to keep monetary conditions loose, where the AI infrastructure build-out is creating a genuine demand shock to the power grid, and where institutional capital is looking for stable income streams with real asset backing and some degree of inflation protection. Utilities, and particularly the ones that have both the regulated income floor and the renewable growth optionality, sit right at the intersection of all of those forces. That's not an accident. That is capital markets working the way they are supposed to work. Money flows towards assets that make sense given the prevailing macro conditions. And the prevailing macro conditions right now are sending a pretty clear signal in this direction. Now, let me connect this back to the broader point about what you do as an individual investor watching all this. Because the frustrating thing about the area we're in is that the people who are benefiting most from dollar debasement and asset price inflation are the people who already own assets. The wealthy are doing fine. Their asset values go up. Their income streams get repriced higher. They continue to pull away. The people who suffer most are the people who do not own assets, who hold their wealth primarily in cash or cash equivalent savings, because the purchasing power of that cash gets quietly eroded over time by the very policies being implemented to keep the economy running and the government solvent. The phrase "you probably don't own enough assets," which has been floating around financial Twitter or X and similar corners of the internet, is actually a pretty precise description of the problem. In an environment of sustained asset price inflation driven by loose monetary policy, dollar debasement, the correct response is to exchange dollars for assets. Not just any assets, assets with real economic underpinning, with stable cash flows, with some pricing power relative to inflation. The mistake people make is they hear that framing and they think it means go buy the most aggressive speculative assets they can find because those are assets and assets go up. But that's not the right read. The right read is that you want assets that will preserve and grow their value in real terms, meaning adjusted for the decline in purchasing power of the dollar. And speculative assets like unprofitable tech stocks or meme coins, and they're not that. They're proxies for risk appetite and liquidity, which are different things. When liquidity contracts, when the Fed is tightening, or when private credit is drying up, as we're seeing some signs of, those assets get crushed faster than almost anything else. The assets that actually hold up in a debasement environment are the ones with real cash flows attached to real things that people actually need. Electricity, natural gas, water, the pipes and wires and transformers and substations that power civilization. That is boring. It is not exciting. It does not make for a particularly engaging headline, but boring is fine when boring is the right answer. And I would argue that right now, boring is the right answer for a meaningful portion of your portfolio. The rotation we're seeing is not the kind that gets talked about in the stock market discourse that dominates financial social media and YouTube. It's not happening in the flashy, high volatility names. It is not generating 25% single day moves or short squeeze headlines. It is the slow, methodical, deliberate movement of large pools of capital by people who've looked at the macro setup and concluded that they want to be in assets that will still be worth owning 5 years from now, regardless of what happens with AI hype cycles or geopolitical trauma or Fed policy pivots. Value stocks, more broadly, have been showing relative strength. Walmart was up meaningfully on a day when a lot of the more speculative stuff was struggling. Companies like ExxonMobil have had strong runs driven by real fundamental catalysts. Target, which everyone thought was going to cut its dividend, held it and has recovered substantially from its lows. These are not coincidences. They are all part of the same rotation, which is capital moving away from narrative-driven speculation and toward businesses with durable earnings, real assets, and the ability to at least partially pass through inflation to their customers. Utilities are the most extreme version of that trade. They are the most protected from competition, the most tied to essential human activity, the most likely to be able to raise their rates over time to reflect higher costs, and the most directly positioned to benefit from the specific catalyst of AI power demand that nobody in the casual investment conversation seems to be seriously talking about. I think the disconnect between how boring utilities feel and how interesting the actual thesis is for them right now is one of those rare situations where the lack of hype is creating an actual opportunity, or at least a rational positioning choice depending on where you are in your overall portfolio construction. And I want to be careful here because I do not want to oversell the certainty of any of this. The macro picture I've described is a plausible and, in my view, fairly probable path, but it's not the only path. If inflation reaccelerates and forces the Fed to stay tight for longer, utilities could continue to struggle in the near term because of rate sensitivity. If the AI power demand story takes longer to materialize into actual utility revenue than the optimistic projections suggest, there could be a period where the stocks run ahead of the fundamentals and then need to consolidate. If the geopolitical situation with Europe stabilizes and the fear around treasury demand normalizes, some of the urgency around the dollar debasement thesis might fade. Any of these could happen. The world is genuinely uncertain right now in a way that is hard to overstate. You have peak uncertainty on geopolitical risk with Iran. You have uncertainty about where monetary policy is going with the new Fed chair. You have uncertainty about whether the AI capex cycle is sustainable or whether it eventually hits a wall. You have uncertainty about the labor market and what the jobs data is going to show. You have hedge funds adding short positions at record levels. I've seen that even as the market makes new highs. And you have insiders selling at historically elevated levels. All that together is a picture of a market that is fragile in ways that the headline numbers do not fully communicate, which is actually another argument for the utility thesis. In an environment of genuine uncertainty, you want some ballast in your portfolio. You want something that is going to hold up reasonably well across different scenarios. Utilities are not going to go to zero if the market has a correction. Their business does not disappear. If there's a recession, people still pay their electric bills. If the scenario I've been describing plays out, if you get a more accommodative monetary policy, a weaker dollar, sustained AI power demand, and a continued rotation away from speculative assets towards real asset income streams, then utilities could be one of the better places to be over the next few years. I think the honest way to end this is to say that I do not know exactly how this plays out. Nobody does. The macro environment is complex enough that anyone who tells you they have it all figured out is either lying or fooling themselves. What I do think is that this setup is compelling enough to be paying attention to, especially if you've been predominantly positioned in high multiple growth names or if you have a lot of cash sitting on the sidelines, losing purchasing power every day. The question you have to ask yourself is not whether utilities are exciting, because they are not. The question is whether the thesis makes sense given the environment, and whether the businesses you are considering have the characteristics that should hold their value or grow their value over the time horizon you care about. If the answer to those questions is yes, then the fact that it is boring is not a reason to avoid it. If anything, it's a reason to take a harder look, because the boring stuff never gets crowded until it is too late to get a good entry. What did I miss here, and what would you push back on? Let me know in the comments. And if you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily 15-minute recordings on market analysis, head over to stockscommunity.com. Try my Discord for just $25 for 7 days. Plus, if you want market updates I can't share on YouTube, sign up at free.stockscommunity.com. If you found this valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it. Let's make 2026 your best year in the markets yet.